In 1971, the United States made a promise it could no longer keep, and to save its currency, it quietly rewired the entire global economy. 50 years later, the dollar still sits at the center of world trade, world debt, and world power. But in 2026, a growing list of countries are trying to walk away from it. This is the story of de-dollarization, why the world runs on the dollar, why so many nations now want out, and whether they can actually pull it off. To understand the present, we have to go back to the end of the Second World War. In 1944, delegates from 44 nations met in a quiet hotel in Bretton Woods, New Hampshire. The old world lay in ruins, and they needed a new system for money. The deal they struck was simple but historic. Every major currency would be pegged to the US dollar, and the dollar alone would be backed by gold. $35 would always buy 1 ounce of gold. That was the promise. For a while, it worked beautifully. America held most of the world's gold. Its factories were untouched by war, and trust in the dollar was total. But promises made in gold are expensive to keep. Through the 1960s, America spent heavily on the Vietnam War, on social programs, on a booming consumer economy. It printed more dollars than it had gold to back. Foreign governments noticed. France, under Charles de Gaulle, began demanding gold in exchange for its dollars, shipping bullion across the Atlantic. By 1971, the vaults were draining fast, and the promise was breaking. So on August 15, 1971, President Richard Nixon went on television and ended it. The dollar would no longer be convertible to gold. The link that had defined global money for a generation was severed overnight. Economists call this the Nixon shock. Suddenly, the dollar was backed by nothing but trust, an act of faith in the United States government. And here's the strange part. Instead of collapsing, the dollar grew stronger. Because Washington had a plan to give the dollar a new anchor, one even more powerful than gold: oil. In the mid-1970s, the United States struck a deal with Saudi Arabia and the other major oil producers. The world's oil would be priced and sold in dollars, and in return, America would provide military protection. This created what analysts call the petrodollar. Think about what that means. If every country on Earth needs oil, and oil can only be bought with dollars, then every country on Earth needs dollars. Demand for the dollar was now baked into the most important commodity in the world. Nations began stockpiling dollars in their reserves just to keep the lights on and the economy moving. And they didn't hold those dollars as cash. They bought U.S. government bonds, lending money back to America and earning interest. This is the quiet genius of the system. The world's need for dollars became the world's willingness to fund American debt. Today, the numbers are staggering. Around 58% of all foreign currency reserves on the planet are held in dollars. Nearly half of all international trade is invoiced in dollars, even when America isn't involved in the deal at all. Most global debt and the vast majority of foreign exchange trading runs through the dollar. The U.S. has what one French official once called an exorbitant privilege. It can print the world's money, borrow at low cost, and run enormous deficits, all because the world keeps buying what it prints. But privilege has a price, and increasingly, other nations are the ones paying it. Here is where the story turns. Because the dollar isn't just money, it's also a weapon. When the United States wants to punish a country, it can cut that country off from the dollar system. It can freeze dollar assets, block dollar transactions, and lock a nation out of the global banking network known as SWIFT. For decades, countries like Iran and Venezuela lived under these sanctions and felt the pain. But in 2022, something changed that got the attention of the entire world. After the invasion of Ukraine, the United States and its allies froze roughly $300 billion of Russia's central bank reserves. In an instant, money that Russia thought it owned became money it could not touch. For governments watching from Beijing, from New Delhi, from Riyadh and Brasilia, the lesson was chilling. If it could happen to Russia, it could happen to anyone who fell out of Washington's favor. And so the search for an alternative accelerated. Leading that search is China, the world's second largest economy and America's biggest strategic rival. For years, Beijing has been quietly promoting its own currency, the yuan, for international trade. It has signed deals to buy oil from Saudi Arabia in yuan, to trade with Russia in rubles and yuan, and to lend to developing nations in its own money. China has even built its own alternative to SWIFT, a payment network designed to move money without touching an American bank. Then there's the BRICS group, originally Brazil, Russia, India, China, and South Africa, now expanded with new members. At summit after summit, BRICS leaders have floated the idea of trading more in their own currencies and even, someday, a shared currency to rival the dollar. Central banks, meanwhile, have been buying gold at the fastest pace in decades, quietly hedging their bets against a dollar-based future. On paper, the momentum looks unstoppable. So is the dollar's reign finally ending? Here is where we need to slow down and separate the headlines from the reality. Because dethroning the dollar is far, far harder than it sounds. First, there's the problem of trust. The dollar is backed by the world's deepest financial markets, an independent central bank, and a legal system that, for all its flaws, protects the rights of foreign investors. When a crisis hits, money doesn't flee toward the yuan or the ruble. It floods into the dollar because that is where the world feels safe. Second, there is the problem of scale. There is simply no other market as large, as liquid, and as open as the market for U.S. government bonds. If you are a central bank holding $1 trillion, there's nowhere else big enough to put your money. Third, and most importantly, there is the problem of China itself. For the yuan to truly replace the dollar, China would have to let money flow freely in and out of its economy, and let the world set the yuan's value. But Beijing tightly controls its currency and its capital, precisely because that control is central to how it governs. A truly global yuan would mean giving up that control, and so far, China has been unwilling to pay that price. This is the great contradiction at the heart of de-dollarization. The countries that most want an alternative are the least willing to build one that the world would actually trust. So what is really happening is not a collapse, but a slow, uneven erosion. The dollar's share of global reserves has been gently drifting down for 2 decades, from around 70% to under 60%. More trade is being settled in other currencies at the margins, a barrel of oil here, a shipment of goods there. Gold is quietly returning to the center of central bank strategy. The world is not abandoning the dollar, it is hedging against it. Think of it less like a throne being overthrown and more like a monopoly slowly facing competition. The dollar will likely remain the most important currency in the world for a long time to come. But most important is not the same as unchallenged. And the very fact that the world is looking for alternatives changes the game. Because the dollar's power was always built on a single foundation: confidence. Confidence that America would honor its debts, respect property, and use its financial power responsibly. Every sanction, every frozen reserve, every trillion added to the national debt chips just slightly at that confidence. None of it is fatal on its own, but trust, once it starts to erode, is very hard to rebuild. So where does that leave us? De-dollarization is real, but it is a marathon, not a revolution. The dollar is not about to vanish, and no single rival is ready to take its crown. But the world of one dominant currency may slowly be giving way to a world of several competing ones. For America, that means the exorbitant privilege could gradually become a little less exorbitant, and its debt a little more expensive to carry. For the rest of the world, it means more choices, but also more uncertainty, because a multipolar money system has no clear rules yet. The story that began in a New Hampshire hotel in 1944 is still being written. And how it ends will shape the price of everything, from the oil in your car to the debt of